Yes, hello everyone. So welcome to the third section of technical content. So this one is going to be more about sort of the trade entries. We're going to be looking a lot more in depth into actual price action. So obviously we've looked at, in our advanced technicals, we saw time and price, we saw some more stuff of market structure and especially on the lower time frames. But this one is going to expand your knowledge a lot more, especially with the types of for example, inducements and everything else that we're going to be going through. But first thing we're going to be going through is risk versus confirmation trades. Now, many of you probably know what this is, but if you don't, a risk versus confirmation trade, what is it? So imagine you've got the perfect sell setup. You've got, let's just say your criteria is area of premium price. Yes, we've got that. That's probably well above a 79 fib. Reacted off previous point of interest. Yes, that's done that. It filled the void. There we go. Liquidity at the bottom as take profit. Yes, we've got a high time frame liquidity at the bottom, and we see is downtrending. And then the last thing and the main thing is fundamentals suggest sells as well. Then you've got the perfect entry, right? So how should I enter? Now, you've got two different types. You've got risk entry and then you've got confirmation entry. Risk entry is setting the limit on the higher time frame point of interest. So what that would mean is you set your entry right here and then your stop loss just above that previous high, just to keep yourself safe. So the good thing is about that, you rarely miss trades and no need to stay on charts really. So you can mark up on a Sunday, for example, and then just watch it time to time. The bad thing is it's more risky as you're not watching the reaction to the area. So let's just say, for example, it hits 130. It's New York and London crossover, and there's some news event that's happening. You've reached your point of interest, but the news event is so volatile that it might take all your stop loss and then go down. What are you going to do then? This is the bad thing about risk entries on the higher time frame. And then you've got the second type, which is confirmation entry. So the way that works is you wait for a lower time frame break of structure. So what that will mean, you understand that all now. You get to your area, blah blah blah. Perhaps you have some type of bearish market structure. You break down, get into the entry, and then boom, you get very nice risk to reward. Good thing about that, you ensure that there's a reaction to that point of interest. But the thing is, you're most likely to miss a lot of trades if you refine too much. So, like I said in the Wyckoff example and how to improve your win rate and everything, if you're using Wyckoff all the time, you're going to be missing a lot of trades because your entry might not be hit in that last phase. Now, if we're talking about market structure here, same thing as well. I mean, you're most likely going to be missing trades if you refine too much. So personally, I would like to go down to the 5 minute as a maximum and then 1 minute just understanding the candles. There's been times where I've hit a 1 minute candle and it would reject perfectly off break even after maybe a 1 to 5, for example, and just let it run. And it would go up to like 1 to 75 with obviously fundamentally backed as well. So let's take a look at this example. What can we analyze? So if we're proceeding from the left side, we've got, first of all, liquidity built right at the top. No, let's go from the left. So as we're going down, we're in a downtrend. Okay, we've reacted off this, still on a downtrend, still on a downtrend. Now we've reached this point of interest right here. It could be, previous order block at a low, whatever it is. We've had this lower low. Now what we've got is this break of structure up. We've broken all of this right here. You see this built up liquidity? We've hit that, filled in that liquidity void. Now a false signal right here would have been this order block. Personally, that could have been a trade itself, that sell. It would go down a bit and then just hit break even. Okay, that's a failed trade. Goes back up again. Then we've got this liquidity built right here, this equal high. We've had this. Then after that equal high, we have that tiny run on liquidity, probably about 1 pip move, go straight back down to this lower low. Now, when we get to that lower low, we reach this point of interest right here, this order block. Okay, so now we've confirmed we've got two break of structures up. We've got liquidity at the top, this lower low, and now we're expecting to have, or this is the higher high in a way. Now we're expecting to have a higher low. And that's exactly what we've got here. Just zooming into it a bit more, this order block right here, this is our point of interest, the consolidation area. And then, of course, we're going to be zooming down into a 1 minute chart or whatever it is. Now, point of interest has been identified. Liquidity at the top, massive, massive liquidity void. That's what we're going to be aiming for as well. Now, how can we enter this? So a risk entry, enter on the higher time frame as a limit. That's exactly what you can do here and aim for them highs right there. And this would be a perfect entry. I mean, stop loss just below them lows as well. You've got this perfect area of consolidation, and then you'd aim for them highs. Maybe just a bit of profit taken at the liquidity void, but that's all good. Then you've got the second type. So what we're zooming on right now is this area right here. So you see how we reacted, jumped up, and then broke down again. That's what we've got here. Reacted, jumped up, broke down again. Now, some people, they could react off of this jump up here, and then react off there. I'll just use my annotation tool. They would consider this perhaps a small break of structure right there. Just break up, and then down, and then you enter off that candle right there. Personally, I wouldn't consider that as an entire break of structure, even though we are on the lower time frame. I would consider this area as a more prominent one, because that is where we essentially got our last sort of up candle just before moving down. Went up, created this liquidity right here at the top, broke down. Now, this could have been a valid entry as well, but you would have been taken out. This, however, just below them lows, was clean, unmitigated. Yeah. And there we go. That's where we went down, and then boom, straight back up. Now we've got this bullish structure. So just a review on what we've just taught right now. Ultimately, the entry types depends on you. It depends on the type of trader you choose to be. So do you have enough time to be on the charts to look at the lower time frame? Are you working full time? Are you working only part time so you can trade a bit more? It really is up to you. Do you seek high risk to reward trades or safer and smaller risk to reward? Here's my take on it. I think when you're trading funded accounts, this is what you want to be aiming for. Because if you're risking 0.5 and your risk to reward is 1 to 5, that's a 2.5% account increase. Usually you aim for 10%, 10% a month. That's 4 trades in a month. That's perfect. Or you can go high risk to reward. Obviously, risk is increased. Risk is increased and the risk to reward is increased. But personally, the way I go about it, this one is for my accounts that are quite small, just a few thousand pound account, for example. This one would be the much higher funded accounts. They're the accounts you can't really mess with, because if you're risking 0.5% on a 3 pip stop loss, I mean, you can do that. And if you're confident in that, I mean, with the style of trading I go for as well, you know, on the lower time frame. But me personally, I still feel like I would much rather not risk it and just go for 4 or 5 trades that bang and get 10% a month and they do well, rather than try to do it all in one trade, because you've got time, you've got a month, you've got 2 months, however long it is. But anyways, guys, hope this cleared up a few things, just whether you're deciding to do either confirmation limits or risk limits or confirmation sells. All up to you. But personally, I use confirmation sells, and then dependent on the account, it's just that will change the stop loss. Anyways, guys, take care, and I'll see you in the next video.